Welcome to the deep dive. Today, we're really going to get into the weeds of financial accounting standards, specifically contract assets and contract liabilities under IFRS 15.
Right. It can feel a bit complex sometimes.
Definitely.
Yeah.
So our mission really is to cut through some of that complexity, pull out the key bits from our sources, and help you get a solid handle on these terms, what they mean, why they're important, and, how they actually impact a business's financials.
Absolutely. And it's important context that IFRS 15, revenue from contracts with customers, it wasn't optional. It became mandatory for reporting periods starting January 1st, 2018.
Right. So a few years back now.
Exactly. And while, say, a simple retail business might not have seen huge changes, other sectors felt it significantly. Think about telecoms. They're always dealing with contracts that have multiple parts, multiple performance obligations, or construction companies, with projects stretching over several years. For them, IFRS 15 really changed how much revenue they recognize and when they recognized it. Big shifts.
Okay, let's unpack that then. These terms, contract assets and contract liabilities. What exactly are they according to the standard IFRS 15? And maybe why have they caused a bit of confusion since it all came in?
Okay, let's start with the official definitions. A contract asset, IFRS 15, says this is the entity's right to get paid, basically, for goods or services that it's already transferred.
Right.
But, and this is key, that right depends on something other than just time passing. Maybe future work the entity still needs to do.
Okay. So not just waiting 30 days for payment.
Precisely. Then a contract liability is sort of the flip side. It's the entity's obligation to transfer goods or services because it's already received payment or the payment is already due from the customer.
Okay. Those are the, let's say, textbook definitions. Very precise. But how can we think about this in a more practical way for someone trying to picture this on a balance sheet?
Yeah, good point. Let's simplify. Think of a contract asset like this. Yeah. You've done some work. You've recognized the revenue for it already based on progress, but you haven't actually sent the invoice yet, or the customer hasn't paid. You have a right to that money because of the work done, but it's not an unconditional right to just demand cash yet.
Okay, that makes sense. It's earned, but not billable, maybe?
Sort of, yes. Or not unconditionally payable yet. And then the contract liability. That's when you have invoiced the customer, or you've even received the cash.
Right, upfront payment.
Exactly. But you haven't done the work yet. So you have an obligation. The cash you've received or invoiced is more than the revenue you've actually earned to date.
Got it. That really clears it up. Now, hearing that, these concepts sound familiar. Don't people sometimes call contract assets accrued income and contract liabilities deferred income?
Yeah, absolutely do. You'll hear those terms used a lot in practice. Accrued income, deferred income. They conceptually map pretty well.
So is it just different words for the same thing?
Not quite. While the idea is similar, IFRS 15 uses contract asset and contract liability specifically. And the really critical point, regardless of what you call it internally, is that these must be kept separate from trade receivables on the financial statements.
Why is that distinction so important?
Because a trade receivable only comes into existence when you've actually issued the invoice, and your right to get paid is unconditional. It just depends on time passing.
Okay.
A contract asset isn't quite there yet. That distinction matters for understanding, a company's real liquidity and its actual obligations. It's not just naming conventions.
Right. That makes sense. Now, here's something I find really interesting. You said the standard came in back in 2018. That's, 6 yeyears ago now? Why is there still confusion around this? It seems like enough time has passed to get used to it. Is there some kind of ghost of standards past haunting the books?
You could put it that way. There really is. A huge reason for the confusion, believe it or not, is that some people are still mistakenly thinking in terms of the old standard IAS 11 construction contracts.
The specific one for construction.
Exactly. But IAS 11 was one of the main standards that got completely superseded when IFRS 15 came along. It's just not the rule anymore.
So people are using outdated rules.
Effectively, yes. Or perhaps learning materials haven't fully updated. It's like using an old street map. You're just not going to get the right picture of how things work now.
Okay, so if applying IAS 11 is the wrong way, what is the definitive correct way to calculate these contract assets or liabilities under IFRS 15 today?
Well, the good news is under IFRS 15, it's actually very straightforward. Surprisingly so, maybe.
Really? How does it work?
It's a simple formula, basically. You take the revenue recognized to date on that specific contract.
Okay.
And you subtract the amounts invoiced to date for the same contract.
That's it.
That's fundamentally it. If the result is Positive, you've got a contract asset. If it's negative, it's a contract liability. Now, of course, if a contract involves performance over time, like a long construction project, you first need to figure out the stage of completion. That tells you how much revenue to recognize to date.
Right, the percentage completion calculation.
Exactly. But notice what's not required by IFRS 15 for this calculation. You don't generally need to calculate the overall estimated profit or loss on the whole contract just to figure out the asset or liability.
Oh, that is simpler than some older methods.
It is. The only time profit estimates really come in is you need to check if the contract as a whole might be onerous, meaning loss-making. But for the basic asset liability calculation, it's just revenue recognized minus amounts invoiced.
Okay, that does sound cleaner. But what about costs? The money spent doing the work. How does IFRS 15 handle those?
Generally, the rule is pretty simple there too. Costs you incurred to fulfill the contract. You expense them to the profit or loss statement as they happen.
As you spend the money.
Right. Assuming those costs relate to the work you're doing, the performance obligations you're satisfying in that period.
Okay. Are there exceptions?
Well, there are nuances. For instance, if you incurred a cost this year that purely relates to work you'll do next year, technically that could be recognized as an asset, a kind of prepayment related to the contract. But that specific situation isn't a major focus in most contexts.
I see.
And crucially, remember that if a cost falls under a different accounting standard, that standard takes precedence.
Like what? Can you give an example?
Sure. So you buy a big piece of machinery specifically for a long contract. That machine is property, plant, and equipment, right? So it falls under IAS 16.
Right. Capitalize and depreciate.
Exactly. You follow IAS 16 for the machine itself. You capitalize it, depreciate it over its useful life. Then the depreciation charge for that machine becomes one of the costs of fulfilling your IFRS 15 contract.
Ah, so the standards work together. You apply the specific standard first.
Precisely. Apply the right standard to the right element.
Okay, so let's boil this down. For you, the listener, maybe trying to make sense of company accounts or even doing the accounting yourself, what's the absolute bottom line here on contract assets and liabilities under IFRS 15?
The bottom line is this. Stick to the IFRS 15 method. That calculation revenue recognized to date less. Amounts invoiced to date. That is the technically correct way to determine your contract asset or liability.
No lingering IAS 11 calculations.
Definitely not. This IFRS 15 approach is the one that aligns with the standard, and it's what's expected in professional financial reporting. Understanding this simple calculation really helps you cut through the noise and see the real picture.
Fantastic. So just to recap for everyone listening, we've pinned down the definitions of contract assets and liabilities, seen why they matter so much now post-2018, understood that lingering confusion often comes from sticking to old superseded standards like IAS 11, and crucially, we've seen the straightforward, correct calculation under IFRS 15, revenue recognized minus invoices sent.
Exactly. And this actually raises a potentially interesting question for you to think about.
Oh, go on.
Well, beyond just getting the accounting right, think about this. How could a really clear understanding of these specific items, contract assets, contract liabilities, empower you? How could it help you ask sharper, more insightful questions about a company's actual financial health? Especially maybe for companies in those sectors we mentioned, the ones with big multi-year projects. What does a large contract liability really tell you about future obligations? Or a growing contract asset about future cash flows? Or potential risks?
That's a really powerful thought, turning the accounting definition into an analytical tool. How understanding this specific detail lets you probe deeper into a company's story.
Something to consider.
Definitely something to mull over. We hope this deep dive has given you that clarity to start asking those questions. Thanks for diving deep with us today.